Good day, boys and girls. Once more, please make sure that you have done task 421 before you go through this video. Babylon Jewelers is owned by B-Baby and sells a wide range of jewelry and also repairs jewelry for which they charge a fee. Number one, complete the following ledger accounts: vehicles, accumulated depreciation on vehicles, asset disposal and depreciation. And number two, the fixed asset note in the balance sheet on the 28th of February 2006. Information given: the following balances, inter alia, means amongst others, appeared in the books of Babylon Jewelers on the 28th of February 2006. So the financial year end for that year currently is 2006. Vehicles, 130. Now, in the additional information, they also state that the vehicle was sold on the 31st of December 2005, but no entry has been put through. What does it mean, no entry? It means the balance that we have there does not include the vehicle, which in effect means that that balance is the balance at the beginning of the year, because the change that happened during the year is not included there. So in effect, that is our opening balance for vehicles. Remember, vehicles is an asset and therefore it has a debit balance. Accumulated depreciation on vehicles 36, there they clearly say that the balance is the one on the 1st of March, the beginning of the year. So remember, accumulated depreciation is a negative asset and therefore it has a credit balance. Land and buildings, 360. And the additional information, they say an additional storeroom was built during the year for 40,000, but was inadvertently, meaning erroneously, entered under repairs in the general ledger, which means once more this 40,000 that should be part of land and building is not included there. So again, since it was recorded under repairs and it's not under land and building, that 360,000 is the opening balance. It's the cost at the beginning. The additions is then therefore 40,000 because we need to fix the error. So whatever we had in the beginning plus the additions then give us the balance at the end. This is done directly on the note since the ledger accounts is not required here. Equipment, 44,000, accumulated depreciation on equipment 40,000 again on the 1st of March. Since we are not required to do the ledger accounts, the information needs to be recorded directly on the asset note. In the information, they say additional equipment was bought on the 31st of August for 14,000, and this has been recorded. Since it has been recorded, it means it is included in the 40,000, 44,000, which means that is the balance at the end of the year. The additions have been recorded, which means the balance that we have is the balance at the beginning of the year. The accumulated depreciation is stated is the balance at the beginning of the year. Remember, we subtract accumulated depreciation and therefore it needs to be in brackets. Some more additional information. A vehicle was sold on the 31st of December, but no entry has been made through. So, the details of the vehicle that was sold is a cost price of 30,000. Accumulated depreciation on the 28th of February 2005, meaning the 1st of March 2005, 12,000. The selling price, it was sold on credit, 17,250, and depreciation on vehicles is calculated as 20% per annum on the cost. So we need to work through the steps. Whenever you have asset disposal, work through the steps and you won't make so many mistakes. What is step number one? Step number one is to update the depreciation on the asset that we dispose of. So When we calculate depreciation, it's useful to use a timeline, and the first thing that we notate on the timeline is the financial year, which ended on the 28th of February 2006 and therefore started on the 1st of March 2005. The vehicle was sold on the 31st of December. So we still had the vehicle for that period of time. So let's start counting. March, April, May, June, July, August, September, October, November. We include December because it is the 31st. And that means we had the vehicle still for 10 months before we disposed of it. We need to update the depreciation for that vehicle for 10 months. The cost price is 30,000. That will be part of step number 2. We transfer that to the asset disposal. The accumulated depreciation on the 1st of March 2005 is 12,000. The depreciation is 20% per annum on cost. So we need to calculate on a 30%, but only for 10 out of the 12 months, 20%. And that equals 5,000. So that means we need to update the depreciation on this vehicle with 5,000. The total depreciation is the 12,000 on the 1st of March plus the 5,000 that we have updated it with now, and that gives us a total of 17,000. And that is the amount we use in step number 3 to transfer to the asset disposal account. We sold this on credit for 17,250, and that is then step number 4. So with step number 1, we will credit accumulated depreciation with the 5,000, and we will debit depreciation with the 5,000. We have updated the depreciation now. With step number 2, we transfer the cost of the asset 30,000 by crediting the vehicle account with asset disposal and debiting asset disposal with the vehicle account, 30,000, the cost of the asset that we have disposed of. We can balance our vehicle account now, and that leaves us with a balance of 100,000, which is also now the balance of our remaining assets. Step number 3 is to transfer the total accumulated depreciation on the asset that we have disposed of by debiting the accumulated depreciation on vehicles account with asset disposal 17,000 and by crediting the asset disposal account with accumulated depreciation on vehicles 17,000. That is now the 12,000 at the beginning of the year plus the 5,000 that we have updated it with now. Step number 4 is to record the selling price. We sold it on credit. The selling price always goes to the credit side, and since we sold it on credit, our contra account is debtors control from the general journal 17,250. We can now calculate whether we have made a profit or loss. Now, our debit side is 30,000. And our credit side, if we add 17,000 to 7,250, it adds up to 34,250, which is more than the debit side, which means our missing amount is on the debit side. And whenever our missing amount is on the debit side, it is a profit on sale of asset. 4,250, we debit asset disposal, and we will credit the profit on sale of asset account with 4,250. Okay, that leaves us with step number 6, where we need to calculate depreciation on the remaining assets. Okay, so again we start with our timeline. The balance of our assets was 130 at the beginning of the year, minus the cost of the asset that we sold, gives us a remaining asset of 100,000 times 20% equals 20,000. So we need to bring that into account by debiting the depreciation account and by crediting the accumulated depreciation on vehicle account, 20,000. Once more, there are two entries for depreciation in the accumulated depreciation on vehicle account. 5,000 on the day of the asset disposal, and then 20,000 at the end of the financial year is the depreciation on the asset that we have left over. We can balance this. It will always have a credit balance, which means the credit side will always be the biggest. So our accumulated depreciation on vehicle account have a balance of 44,000 at the end of the current financial year. Depreciation, remember, needs to be debited with 20. Now we need to complete the asset note with the rest of the information. There's additional equipment that was bought. So that is additions at cost for equipment, 14,000. Now we also need to calculate depreciation on our equipment. Now the depreciation on all equipment is 15% per annum on the diminished balance method. How do we get diminished balance? Cost minus accumulated depreciation. Again, let's draw our timeline and record all our information on this timeline. Okay, the new ones was acquired on the 31st of August. So the new ones we only had from when? We start counting at September, since it's the 31st of August. So September, October, November, December, January, February. We had it for 6 months. The balance was 44,000 at the end of the year. The new ones was 14,000, which means the balance at the beginning of the year was 30,000. So 3 is the old and 14 is the new. So the accumulated depreciation at the beginning of the year was 14,000. So on the old, it is the cost minus the accumulated depreciation times 15% equals 2,400. That is on the old. On the new, there's no accumulated depreciation yet, so it's 14,000 times 15%, but we only had it for 6 months. So it's times 6 divided by 12, and that equals 1,050. So the total depreciation that we're going to write off on our equipment for the year is the 2,400 plus the 1,050, giving us a total of 3,450. So that is what's going to the depreciation in my equipment column, 3,450. So if we take the cost at the end minus the additions, it gives us the cost at the beginning. If we take the accumulated depreciation at the beginning and subtract it from the cost at the beginning, it gives us the carrying value at the beginning. If we take the accumulated depreciation in the beginning and we add the depreciation for the year, it gives us the accumulated depreciation at the end of the year. So our total movements is the 14,000 minus the 3,450. Our carrying value at the end of the year, 2 ways of getting that. Okay, so we are done with the equipment part, and we can now take the ledger accounts from the vehicles and transfer the information from there onto our asset note. There's the cost at the beginning of the year minus the cost that goes to the disposals at carrying value, and that gives us the balance at the end of the year. That is from the vehicle account. From the accumulated depreciation account, we can also transfer the information. There's the balance at the beginning of the year. Remember the brackets. The depreciation for the year is now the 5,000 that we calculated on the disposal, plus the 20,000 on the remaining asset is 25,000. Remember, we subtract it, so it is in brackets. And then minus from the cost of that disposal, the accumulated depreciation for the asset disposal, and then the balance at the end of the year goes to the accumulated depreciation at the end of the year. Now we can also finalize our note. If I look at the disposals, the 30,000 minus the 17,000 gives us the 13,000 as the disposals at carrying value. Now the cost at the beginning minus the accumulated depreciation at the beginning give me the carrying value at the beginning. The movements is the 13,000 plus the 25,000 in brackets. And then the carrying value at the end of the year is the cost minus the accumulated depreciation at the end of the year. The only thing left to do is to add up horizontally to complete the total. Our depreciation account, we need to update still with the accumulated depreciation on equipment, and that will be closed and transferred to the profit and loss account. And that is our complete note with the totals also completed.